Let's start our Wrap the Week segment with a poll. We always have a poll running on our StockCharts TV page. We'll also run them through social media and elsewhere. Recently, we asked, this is an interesting one, will the next 10% move in the S&P 500 be higher or lower? And out of all the responses, it was fairly close, but 56% of you said lower, only 44% of you said higher. Now, it's interesting, as the S&P is testing all-time highs, we're going to bring up chart of the S&P here. When you look at the S&P making new all-time highs, 10% higher is another 420 points. That puts us at 4,600. 10% below here, is about 420 points below. That's about what, 3,700. So the question is, do we go to 3,700 or do we go way up here? And it's interesting that more than half of you said that it's more likely the next 10% move is lower, really retesting those lows from February and March. I did not vote in this poll. If I did, I would agree with the majority. I think that, given the overextended environment, given the fact that we've recently been overbought, given the fact that so many stocks are showing weakness that I think is not reflected in the chart of the S&P, I think, again, I maintain that the S&P is making things look better than they are. I wouldn't be surprised if we get a meaningful pullback down to 3,700. That's a 10% drop that will feel like an 80% drop, given how strong things have been. You see how things felt earlier this week when the market was down a little bit after being up so much. It doesn't feel good. And so if we have a steep pullback or an extended pullback down to 3,700, that would hurt. I think that would be quite a move for a lot of people to digest. But think about how much further, in my opinion, think about how much more constructive the market could set up to be if it has that sort of pullback to sort of make sense of all this recent overheatedness. You could not then claim that the market was overheated. You could not really claim it was overvalued, at least not to the extent that it is today. And it would alleviate a lot of these negative patterns that we've seen or signs of euphoria. That would certainly, take some of the euphoria out and potentially set us up for further upside. So very interesting poll. Thanks everyone for responding on that one. Let's continue on here with our Wrap the Week segments. What we usually start with is a chart of the S&P and other major asset classes. I'll walk you through what these different lines represent here very quickly, but this is showing the last Friday's close on April 16th to where we're at today, locking in the close and what changes we've seen. So essentially, and this is when I talk about the markets being in digestion mode this week. And again, I always, when I use that adjective, think of it as you've had a big meal and then you just need to chill. You need to relax and let your body digest what's happened. It's not about eating more. It's not about, eating less. It's just about, having a pause. And when you look at what the S&P has done, even though we had a nice rally today, even though we've had a lot of nice movements during the week, some down days and some up days, overall, the S&P net down 0.1%. That's essentially a zero for the week. So with all the movement, all the volatility, all the earnings, misses and wins, the S&P essentially went nowhere for the last week. This is truly a digestion week, a pause, and then setting the stage either for a rotation lower next week or a break to new closing highs, which we did not quite get today, as you can see, because that was last Friday there, and we're a little bit below there, but close, but pretty close on an intraday basis. So we did make an intraday high. It looked like just barely. So the S&P for the week down 0.1%. What outperformed the S&P? Gold, essentially flat for the week, 0.0%, rounding down a bit. Here's small caps and emerging markets, which were both around 0.5%, about 0.5%. The biggest gainer was the bond market, actually. The TLT was up about 0.6%. The S&P, again here, 0.1 to the negative. What underperformed the S&P to very, very close around negative 0.8%. That's the US dollar in green. And that's the NASDAQ 100 in pink. So, it's funny. I posted something yesterday about, or maybe this morning about the NASDAQ, not impressing. And just the fact that the relative strength has been deteriorating, even though it's doing okay. And I got a lot of pushback for that today because the NASDAQ does just fine, outperform the S&P. And I got a lot of heat for that sort of thing. But I stand by it. The juice has not been technology, but it's been other places. I don't think this week really changed that with a week of the NASDAQ underperforming the S&P. Here at the bottom is actually crude oil down 1.7%. Energy certainly has been has struggled a bit. Some of those energy stocks that reported this week, like SLB and Halliburton and others, sort of right at that decision point. The question is, are they pulling back to an actionable level, an ascending 50-day moving average? We ride the next leg higher, or is this the beginning of further deterioration? I don't know what the answer is going to be. I think we have to wait and see for next week. By the way, if you're thinking about cryptocurrencies, this was Bitcoin down here, down 17% over the week. So here's everything we just looked at compressed here at the top. Here's Bitcoin. There's no doubt that Bitcoin has rotated in a lot of cryptocurrencies from huge uptrend mode with no top ever in sight. This thing's going to go shoot the lights out and continue on forever. Certainly seeing a give back in Bitcoin this week. And again, overall, this is the challenge with something like Bitcoin. It's been up so much, even with the pullback, it's still holding some pretty key levels, right? If you look at the chart of a Bitcoin, we'll start there for a moment before we continue on with some of the other charts of interest. Here's Bitcoin here. Today, we actually traded below the March lows, which is a really, really interesting level. 50,000 is sort of the key line in the sand. We talked about two of them recently. Once we pull back a little bit, the levels we keyed in on are the early April low, which is around 56,000, just below that. We actually broke that and continued down through the remainder of this week, through the second half of this week. We're now testing that 50,000 level. And I think 50,000 is a key one psychologically, but it's also key support on the chart. We traded below it, but closed back above it, which at this point is an indication of a pretty valid support level, right? Something we trade below, but buyers clearly coming in. And when you get below that level, push the price up to trade back above it. Holding 50,000, I would argue, would be really very, very important. If it breaks that, 42,000 is this shaded level here. That's the low from late February, also the high from early January. That's a really significant price level there. And that would be the next objective I would be looking at. The 200-day moving average, by the way, is all the way down here around 35,000. So you have to give back quite a bit to still remain above the 200-day moving average, which it hasn't touched for about a year, and still be within a long-term uptrend if that's your definition of it. But again, overall, I'd be looking over the weekend and into next week if 50,000 is able to hold and push Bitcoin back into a long-term uptrend. Let's continue on here looking at the Mindful Investor Live chart list. This is where we usually like to spend some of our time on Friday's show as we wrap the week. As a reminder, to get to this, if you've never done it before, go to the articles section of StockCharts. In the upper right where it says all StockCharts blog, go to my page, which is called The Mindful Investor, and there's a link at the top to a live chart list. That's going to be this one, and you'll get to this list of charts. You're welcome to save them to your login. Do whatever you like with them. They're yours to use. Let's start with the S&P market trend model. This is a weekly closing closing data that it's using to driven a model on 3 timeframes. The long-term model is based on the 21 and 34 week exponential moving averages. That has been positive since June of 2020, and nothing has happened to change that. It remains long-term secular uptrend. The medium-term model is more of the trading model. That more tells me when to lean into or away from stocks in general. That went negative from mid-February to late March, which is why you certainly heard my tone become a lot more cautionary, because that model tells me to start tapping the brakes and not be looking necessarily for new long ideas. That reverted back to a bullish signal at the end of March and is signaling through this Friday's close that we're continuing to be a thumbs up. The short-term model is simply looking at where we're at relative to the 5-week EMA. That's been positive for the last 8 weeks now. So overall, across the board, the model is positive. For me, that tells me to be comfortable looking for new ideas, to be riding longs, to be looking for good stocks breaking out, and in general, looking at the new 13-week buy high list and 13-week low list for opportunistic moves. And it's interesting, if you look at that 13-week high list, number one that I would notice is there've been a lot of stocks on there. A lot of stocks continue to make new 13-week highs, and they're clusters of names. And for example, this week, things like auto parts stores, what would I put in? AAP, Tractor Supply Company, TSCO. These are the types of stocks that have appeared on that list pretty consistently this week, worth paying attention to. Chart number 2, the daily chart of the S&P. And I spent some time earlier today kind of tinkering with the lines on here. I had some Fibonacci retracement lines that were really driven off of the February and March highs. The fact that we've broken above them sort of invalidates those as significant resistance levels, and we're more in a new uptrend. So I don't have any Fibonacci levels at this point because we're in a pretty good uptrend. You apply Fibonacci levels when the market starts pulling back. And the question is, okay, now that we're not going up anymore, where might we find support? And that's when you start throwing Fibonacci levels on here. Right now, when things are kind of long and strong, making new all-time highs every week, you don't necessarily need those on there. And I'll let you know when we need to start revisiting those. So what happened when I took the Fibonacci retracements off and just looked at the price of the S&P, I noticed some interesting things. Number one, if you draw trend lines from the October low, which was sort of the end of this base before we broke out and continued on for the next subsequent 6 months, the first major pullback, I would argue, where you could draw a trend line of support was taking the October low and the late December low that lined up with the January low and the late January low. So a pretty valid trend line. We broke that in late January, bounced off the 50-day. So now we take a new trend line using that level from the end of January. That lines up with the low from the end of February. We then broke that one and broke down through the 50-day before reverting higher. Now I'm drawing a trend line from that subsequent low. And this idea where it's called a fan, where I keep taking the next low and drawing a new trend line. So what happens is you tend to not have more than 3 of those. Now that is a total like traders thing. I mean, that's not something, I don't think that has been rigorously back tested, but that's what I was taught early on, subjectively looking at trend lines, because more often than not, if you have to keep drawing trend lines, at some point the trend breaks and it no longer goes higher. And so I think that trend line taking the October low and now the March low might be a really important one. And what's interesting right now is it's right where the 50-day moving average is. So if and when we start selling off, which at some point I am certain we will do, it's not today, but at some point when we do it, I would be looking at that area. And that's around 4,039.50 to 4,000 at this point. That can change. Obviously, the longer it takes to get down there, the more that these lines will appreciate and that level will go higher. But I think, we remain above those things, the 50-day and this trend line, which is what we've been able to do through much of this uptrend. That tells you that the pace of this uptrend is fairly consistent. There's no reason to be too concerned about it. We don't have a ton of time left before the break, but I just want to jump really quickly and hit some of these other charts. Some of these we've reviewed randomly. The cumulative advanced decline lines all confirming new highs, except for in small caps where you have not had an upside confirmation. It'd be interesting to see today. This is not updated through Friday's close just yet. It'd be interesting to see if that finally confirms a new uptrend, but it has not. We've seen an expansion in new highs. That is what an uptrend looks like. That is not bearish activity. Almost 100% of the S&P are above their 200-day moving average. And that, for me, as always, makes me nervous. When that many stocks are in an uptrend, it tells me to be concerned for some reason. It tells me to put on the contrarian hat. Some stocks actually coming below their 50-day, which is what that green line at the bottom is rotating. But overall, that's still very constructive. Worth noting that the Rydex Funds, we'll have to leave it here, but if you look at the Rydex Funds, thinking about sentiment, we talked about this yesterday, that Rydex level is at the lowest level in history that I track on StockCharts. I basically inverted this so that it's more in line with other sentiment measures. If these bars are very very high, that shows you that it's bullish positioning. If it's very low, that's bearish positioning. So the fact that it's very high is sort of a euphoric reading, all-time euphoria, suggesting that individual investors are basically all in. They can't get any more bullishly positioned than they are right now. That doesn't, to me, seem like the beginning of a lot of further upside. That seems like more something I would see at the end of a bull market phase.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.